Thank you, Rich. As noted, my name is Glynn Tonsor. Most of you probably heard me before. Probably a good time for a joke. I used to have more hair, long, blonde, flowing. That's a lie. Been a long time since I had a full head of hair, much less long and blonde. But more seriously, thanks for coming. Those of you who kind of know the drill here, these slides, everything's available to you. But more generally, these kind of presentations get updated over time. So I'm going to share a lot of information on the cattle market. So weekly charts, forecasts, all that kind of stuff. You know, I'm bringing it into talks regularly. And I'm bringing that up because what I share with you today is valuable. Please come back to Ag Manager, get a more recent slide deck and go through it. Even if it isn't labeled the Ag Lender slide deck, there's going to be a lot of commonality with other meetings. So if you find value in that, please go to Ag Manager and do that, please, periodically. I want to start with kind of a summary. I'll give you a lot of details underneath this, and then presuming we're still on time and so forth, I'll book in this and give you the summary again. On the supply side, by far the biggest question that I get, it's not just me, it's anybody that's attempted to talk on the market, is where are we at with herd expansion? The punchline would be is I don't think we've started herd expansion. I think January of 2025, USD will tell us that we actually start the upcoming calendar year a hair lower than we started 2024. Now, rounding error is similar, so don't think a lot lower, but the point is we have not started expansion. I don't know anybody that's really saying we have yet. My best guess is next June, July, when we have calves on the ground for the next calf crop, there will be some individuals that start the process, but it won't be a real market relevant expansion effort yet. So we'll know isolated cases, but it won't be nationally relevant expansion yet. By the time we get to the summer of 2026, as of today, I think we'll hold a lot of heifers out of that calf crop. So if you follow me, we haven't started herd expansion yet. I don't think we'll be doing much in 25. But by the time we get to summer of 2026, I think a lot of producers will start holding back heifers, is the net of that. Okay. With that, anybody that needs feeder cattle, so stocker, backgrounder, feedlot, packer, processor, is going to have fewer hooves for the next at least 3 years for that story, if not longer. And we're going to have more and more chatter discussions about physical use on assets that aren't running at full capacity. We've had this in the past, right? The packing industry in particular, early in the pandemic, we had a lot of those discussions. Weren't able to handle the cattle and so forth was part of a capacity challenge. But the next few years, when we have fewer animals, lower hoof count, we're going to have excess space, right? Physical capacity is going to exceed the number of feeder cattle for every word post-calf for a while, and that's going to weigh on margins. On the demand side, most of you know, probably I spend quite a bit of time trying to monitor and track lots of things in the meat demand space. Specifically to beef demand, I have two really scientific statements up there: reasonably robust and softening. Those are pretty broad, so you can't pin me down too much, right? If you put the 3 or 4 year horizon around this, I would say beef demand has been pretty robust. But if you ask me about the last 3 to 6 months, I'd say it's been softening. So that's where that's coming from. And I'm going to break that down more as we go forward. I'm particularly worried about restaurant demand. This is the specific part we'll talk more about. I'm going to give you some very probably painful distinctions between per capita consumption and demand, because those concepts get confused. And I'm going to ask you to help me help get producers less confused on it. And it's really important as we're in the process of shrinking hoof count, we're pretty much guaranteed to shrink per capita consumption. I'm going to hold our hand on that in a minute, but that does not mean that beef demand goes down. Beef demand might go down, but just because per capita consumption declines doesn't mean beef demand goes down. I'm going to belabor that because it's a really important point. And several times through these slides, I'm going to make the distinction between nominal and real. Bankers should understand this, of course, but we're coming out of a period of elevated inflation. This is really important to appreciate, and it has real implications for the net margins that are real dollars for producers versus sticker price, which are nominal. And a lot of the discussion in the media is triggered by nominal discussions, but a lot of economic decisions boil down to real margins. And that distinction, probably I would tell you, is always important, but it's of elevated importance for just 2 years after 8-9% inflation. So we all got to keep that in mind. I won't spend that much time on every slide. That's kind of a summary, and then give you a lot of details. These next 2 slides are from LMIC, the Livestock Marketing Information Center. It's a group based in Denver. Each row here corresponds either with a quarterly value, or the yellow rows are annual values. We have commercial slaughter to the left. In the middle, we have dress weights, and to the far right, we have the net of that, which is commercial beef production. The purple arrow tells the story with one exception, and I'm going to break down the exception in a minute, but the general arrow being down is driven primarily by the hoof count point. So if you look to your left, the commercial slaughter numbers, and these would be fed cattle, like steer, market ready steering over numbers. These are all year-over-year declines. This year, 4% lower slaughter, next year, almost 4%, out to 2026, an additional 3.5%. So even at the end of the production chain, right, think 1,450 pounds steers and heifers, we're harvesting less of them persistently compared to the year before. This is pretty much just because the cow numbers have been declining, later this catches up, right? In the middle, the dress weights, that's the exception I want to call out. Specifically, I've put a blue bar around Q2 and Q3 of this year. Q3 is now fully realized, but that's a new observation we were front end of October. So that Q3 would have been a projection when they put this out in the middle of September. If you notice here, the second quarter of 2024, dress weights were up by 4.1%. I would argue the biggest thing that's weighed on the fed cattle market in 2024 was the market was surprised that we actually had a period where we had more beef being produced than last year. And that's why I put a box around this. So the net of those additional 4 pounds on each animal was more than enough to offset the decline in animals. So in the second quarter, we had almost a 1% increase in beef production compared to the second quarter of 2023. And in the third quarter, it was slightly up as well. So in Q2, in particular, and a little bit in Q3, beef production in this country was ahead of the same quarters of 2023. If I was in front of you back at Christmas, we weren't expecting that, okay? And the market wasn't expecting it because we didn't expect this. So the industry pushed the animals, they held them in the yard longer and they put more weight on them than we were anticipating. Okay, is the punchline of that. And that pushes back up fed cattle prices because the beef volume in our market is higher than we thought it would be. It's an anomaly on this forecast because we're not expecting that to continue, okay? So looking out to next year and further out, these are maybe a little bit more year-over-year first quarter, but then declines in dress weights are projected. Dan's probably not going to tell you we're going to have a massive rally in grain prices that are underneath that. Rather, I would say it's because we're starting from a higher base of animals, and we don't expect an additional 3 or 4% to be added, is the way to think about it, because these are year-over-year changes. So if we have flat, even much less down, added to down on hoof count, then we're definitely going to have less beef being produced, right? Those times pounds gives us total pounds on the market to the tune of maybe 5% less beef in 2025 and an additional 4% less in 2026. So what does that mean for cattle prices? This slide's set up the same way, but instead of hoof count pounds, it's animal prices. 5 market averages first, followed by yearling 7 to 8, and then the calf market. This is a simpler story to tell. These are generally all up. I'm going to break these down by weight class in a little bit, a few slides. But just to give you a couple of numbers here, the calf market, fourth quarter, 301 to 305. So a $3 calf is what LMIC has forecasted. Most of you know we're about on the front end of the heavy calf run, right? Look out to next year, 309 to 317 for the fourth quarter, 312 to 323 for 2026. I said this yesterday in a couple of meetings. If I'm correct that 2026 is the summer that we pull a lot of heifers out of the market, so who knows? It has to be given 2 years for that to happen, but as of now, that's what occurs. And nothing drastic changes otherwise, which is a very unlikely thing to happen in the next 18 months. But regardless of those are the 2 combos, I think this 312 to 323 is way too low. I think it's way more likely we have a 350 calf than a 250 calf. And if you, which way would it move? I think it's way more likely we have a very hot calf market in 2026 because we pull a lot of heifers out of the market in 2026. If that is correct, I think either 2026 or maybe 2027, if the expansion's a hair delayed on when we started hard, will be the peak calf price in this upcoming cycle, is the point of that, okay? So to give a little further with that, my really best guess is 2026 is going to be the high year for returns per cow for cow-calf producers over this next 8-10 year period. All right, so some context. Yeah, go ahead.
You tell me again why the dress beef will go down. If you make a legal holding.
Fair question. So we bumped it up. These forecasts are for it to go down a little bit. These aren't my forecasts, they're LMIC's I'm bringing to you. I think you can make a compelling argument that those be flat. So I wouldn't argue with that. And what I want to impress on you is even with flat, we're still producing less beef. Okay. I'm quite confident that we're not going to have this anomaly we had in 2024 to where we put enough more pounds on to offset the pounds to where we surprise the market will be. That I don't see coming. Okay. You can easily convince me these should be no change. The second quarter one is probably the hardest one to convince me of that, and it's the biggest negative. Because these are year-over-year numbers, and we really pushed up last year's Q2 number. So it improves the odds you're gonna pull back from a high, right, is the point. But you can convince me most of these would be flat, and I wouldn't argue. The economists that pulled this together probably have a little bit of caution that we're gonna stay real heavy, because historically, there's been some heavyweight discounts come back. I don't think that'll happen in the next 2 years, because the industry is gonna be short on cattle. And in the past, we don't have heavyweight discounts when we're short on cattle. We have heavyweight discounts when we're flush with cattle, because you can be picky. But I don't think the industry will be able to be picky for the next 2 years. So I would not disagree at all if you want to make all those no change. And it would slightly reduce these negatives. We have a little bit more beef on the market, but it'd still be less than they have here. Where we have with beef cow numbers, this chart goes back to 1994. It's mainly just to give you historical context of this herd expansion discussion. You guys know this past, if you go back 50 years before that, late 60s, early 70s, we had a cow herd of 40 million cows. And then we got to the 90s, we're in this, mid 30s. You get to the current cycle, 2019, we're 31.7 million cows. So that was the peak in the cycle we're currently at. We started this calendar year at 28.2. I made the comment earlier, I think we'll start 2025 a little low, like 28 flat, 28.1, something like that, just a few less, 100 or 200,000 fewer cows is the best guess here in a few months when USDA puts out their herd estimates. If that's the case, then this line comes down a little bit more. And I think that's when we'll start the next 8 to 12 year cycle after that. Happy to take questions on it. I don't think we're going to break that high. So when we do expand, I don't think we'll get back to 31.7 million cows. If we do, a year after we do it, cow-calf returns will be really bad, because the amount of beef production that comes with that will be a lot more than we had the last cycle. That said, I'm pretty sure we'll expand a little bit beyond what is equilibrium rational, because we're going to do that, right? Pendulums go a little bit too far, but I still don't think we'll hit above 31.7.
You think that cattle numbers will be trending down in the future, as far as, it was over 35 million head of export. Will we ever get to that point again, do you think?
No.
You want to repeat that for the online?
Sorry, I'll try to remember every time. So the question from the back, which these are great, thanks for being online, was do I think we'll go back to above 31, 35 million cows? Will the trend continue to lower? I definitely don't see us going back to 35 million cows. Will the rate of decline be the same over the next 30 years as it's been the last 30? That's a little more complicated. But my punchline of these next 3 slides is to your question, and I'm not going to break every one of these down, but we have a fact sheet you can go look up that's the history of cattle cycles. This figure is in it, and the punchline from that fact sheet is across each cattle cycle, the last 4 in particular is what this figure is about, is we're getting more beef per monocow in the system. So the number one reason that I don't think we're going to go back to old highs is we don't need to hit a beef production target. It starts with the dress weight discussion, back to your question about will we sustain higher ones and so forth. I mean, the industry has succeeded notably getting pounds on steers and heifers in the yard, and we're probably not going to go backwards. I mean, we might a little bit as grain gets more expensive, but on balance, we're going to keep them historically high. But I also want to give credit to stuff even before the feed yard. So breeding success, weaning success, calf health, everything that we do before you put a yearling in the feed yard has also got a lot better. So we get more animals per cow, and we get more pounds on each carcass, right, in the system. The net of both of those is a lot more beef per mama cow in the system. And my opinion is the economics in this whole story start with the tonnage and the quality of beef. That's the connection to consumer demand part. And I'm going to work backwards on the industry is how do we accomplish that? How many cows do we need for it? And we don't need 35 million cows to do it. So I hope you follow my narrative there, but I don't think we're going back to the 35.
After you discount carcass weights, you think that's going to disappear then?
So historically, when there's been notable heavyweight discounts, it's when the system's fairly full. When you can run your 40-hour shift and at least periodically run Saturdays. When there's confidence we can't run the 40-hour shift, much less Saturdays, I don't think you'll have the same discounts. Would that day come back? Yes, but only after we mothball up plants. Right? And these aren't fun discussions. But if you follow what I'm saying, we're not going back to old numbers, we're not gonna have the hoof count of feeder cattle. That we ever, I mean, never get back to the 35 million applied, right? So I'm not convinced we need more plants if you really want to press this because of that. So I think in the next 3 years, there's gonna be plant mothballed and several change ownership.
Why are you thinking 26, the rebuild?
I'll get to the return. Yeah, sorry. Why am I thinking 26 for the rebound? I think the average cow-calf producer is a little cautious at the moment. They have yet to cash more than one good calf crop. And they want to see Mother Nature keep giving them moisture for more than 12 months. So that's why we haven't done it yet. Why do I think it'll happen by 2026? Because I'm going to show you some decent returns in a minute that if realized, it'll incentivize it. That'd be the one. And that's where I'm going here. This tool is to help you understand the net present value. Lenders understand what net present value means, so I won't interpret that for you. But underneath this, we put the next 10 years calf prices per USDA, Kansas Farm Management Association cost to run a cow for the year. And I think 8.5% discount rate are the three most important inputs into this tool. You can change those inputs for your own operation, you're working with a producer and so forth. But the main output of this tool is a net present value of adding either a heifer is going to give you 7 or 8 calves. You can use it for buying like a 4-year-old cow that might give you 4 calves. You can do the same thing, it's just the duration of the investment's shorter, right? It's an emotionless tool that I think has value all the time. But if we are on the front end of herd expansion, these kind of tools ought to be used even more in the next few years. Where are we at with calf prices? And I'm going to get to margins to come back to your 2026 question a little bit. This is the calf market. The lighter blue line is 2024 so far. The kind of black dotted line is 2023. What's most relevant for this slide today is we're now basically at the same calf price we were last year. But much earlier in the year, we had periods of 60, if not $80 hundredweight ahead of last year. And sitting here today, looking backwards, crystal ball's always, we all look smart looking backwards, of course. But the peak in this market was, say, April 1st, okay, give or take a couple of weeks. Last year, you were rewarded for not pricing in April and just wrap it out and take the cash, market in the fall. I'm going to interject here. I'm not Nostradamus. I don't know how next year will go at all. It's not the point of this, but these 2 years are very different. The peak in the calf market this year was back in April. Last year, rewarded for waiting. More often than not, seasonally, the calf market does better around April than it does October. So 2023 was an odd year from a historical context for calf market. For seasonal pressure, we tend to have a lower price here on the front end of Q4, mainly for supply reasons, because a lot of calves hit the auction market, right, in October, November. So I'm not telling you 2023 can't happen again, but I am telling you I would bet on it happening real often in a 10-year window. So the current year is more likely to be the norm than last year when you're thinking through this. I'd like to remind people this resource called Beef Basis. It was built by Kevin Duvet and myself here in the department with some folks that run a large ranch in Wyoming. It pulls CME futures, feeder cattle futures market information the night before, marries it up with historic basis, so futures relative to cash for whatever market we're talking about. What I have in front of you at the moment is for the scenario where I'm in the business of selling a steer calf in the middle of October in Salina. So there's different markets in this. If you're listening, you're from Southeast Kansas, pull up the Joplin market. That's probably more relevant than Salina. So you can pick, these are all drop down menus. You can pull up different markets. If you're listening from Nebraska, there's Nebraska markets and so forth. If you drove here from further west, you can do Dodge. So pick the market that's relevant. But the number you'll see there is 275. So that's the market-based historic basis originated, like futures plus historic basis. The forecast is 275 for a 6-weight steer. That's 25 below what that LMIC chart was. My third slide. Okay. That reflects there's about a 10-day difference in when these forecasts were done. Those 2 slides I gave you that in yellow rows, if you remember, they were more the middle of September when they were dated. They're updated periodically. This was a little bit more recent forecast, reflective of changes in the board. So 275, maybe $3, right? Calf price times 600 pounds gives you some insights on the revenue. That doesn't tell me anything about profit, because we got to talk the cost for a moment and marry those up. This slide is about cost, 1997 to now. What USDA estimates in the past and then forecast for the next couple of years is the cost to run a cow for the year. 2020, the number there is 830. So USDA estimates that in the year 2020, it cost $830 calf cost per cow. You can add $250 to that over the last 4 years. So 2024, 1083 is the number. Okay. So back to the comment about, why 2026, the why we haven't done it yet point. This is where this is very relevant. We've increased the cost and just the break-even cost, right? What you need from your calf just to cover cost is quite a bit higher than it was just 4 or 5 years ago. And I think the average cattleman is well aware of that. What does that mean for margins? This is the net of those stories. So returns over cash cost, again, 97 through now. For context here, 2014 was $534. For 2024, LMIC is forecasting $622. So I did this yesterday, I'll do it again. You guys think for a moment before you respond, because yesterday did this right, so I want you guys to do this right. Given these forecasts, do you think the 2024 typical cow-calf producer is going to have a better year than 2014? So raise your hand if you think the typical producer, or what you're looking at, is going to have a better year in 2024 than they did 2014. You think about that for a moment while I take a drink. Nobody gonna raise their hand? Good. The tone of my voice usually gives you the pause, right? Don't raise your hand, don't raise your hand. And you shouldn't raise your hand because those are nominal numbers with a decade between them. Several years of 2 to 3% inflation and at least one of 8%, right? What's up here is a note, is a reminder, and you can read these in your notes later, is I think 2024, given the inflation that's occurred and the current forecast, is gonna still be behind what 2014 was. Please understand, I'm going to tell you, cow-calf producers, if they have an average crop and average cost, they're going to have a good year. So don't misunderstand me here. It's shaped up to be a good year, but not as good as it was in 2014. And I'm trying to give a frame of reference because a lot of producers make that comparison. Right? That's what this inflation comment here is. The other part of this is those comments are on an average, and average masks a lot of variation. For those of you that have actual cattlemen on your books, no. There's wide ranges of profitability that mainly reflect wide ranges of cost structure. So the KFMA data points to a $600 range between the top third and the bottom third within the KFMA data set of cow-calf producers. When you go to the enterprise level, that's a very wide range, okay? So this 2024 number, 623, I think there's several producers in Kansas that are gonna truly make over $1,000 a cow this year because they have lower costs than we're up here. I also think there's several producers that have a full calf crop. They're going to make about $100 because their costs are way above what the average is. Okay. Both can be true. My point in this is average mass, a lot of variation, but it's even more important to recognize that as these costs have went up, going back to this slide, as they went up for the average person, there's just more dollars in the system to manage. And if you're behind on management or just not good at management, you're going to fall behind even faster because there's more dollars in the system that you're missing out on being the student manager on. And conversely, if you run a real tight ship, you can get ahead even better because there's more to be managed. There's more opportunities to differentiate yourself. So the pain of being a bad manager is steeper. The reward of being a good manager is higher, is the point. This $600 I have up here, this differential between the top and bottom thirds, 3 years ago from KFMA, that was $400. So this differential has grown, right? There's nothing surprising in that. But I think it's really important to recognize it as we raise what it takes to run a cow for the year, raise the cash requirements to do this business, the returns to being a student manager are growing as well. My last comment back to your 2026 inquiry. I think not only are producers cautious, they want to have more than one calf crop, they want to see it rain for more than 1 year, all these kind of things. If you follow my comment that we aren't as good as 2014, hopefully everybody follow me on that because the inflation effect, that's on a per cow, like $1 per cow. $1 per head kind of basis, and it's accurate, right? I'm not misleading you. But this return on investments, when we put things on a percentage return front, it's actually even worse. So we aren't quite to where we were on 2014 per head, $1 per head, and yet we have at least $200, if not $250 more per cow in the system. So we're actually still even further behind on a return on investment. More capital involved to accomplish something that's not quite as good, right? You guys follow that? So it's another reason I think cattlemen are cautious because the investment's larger and we have yet to get to the same ROI is the point. So I think it's actually rational. The typical person hasn't expanded yet. Sorry, I'm getting up in my clicker here. I have up here for 2025 and 2026 forecast for those returns to get a little bit better, maybe 780 out to 2026. That is a big number historically, but if I've done my job with you today, it's convinced you that that isn't as big as it was a decade ago. Okay, so I do think the typical cow-calf producer is in the midst of a 2-4 year profitable run. Not trying to mislead you, but we got to think through the sticker component of that. It isn't as big as it looks like once you account for the cost to accomplish this. So I think those will be big enough and multi-year enough that we will start the process in 2026 if everything goes the way that it currently looks. All right, I'm going to jump ahead here. This chart is the same. It's yearling prices. The same thing I told you earlier about the calf market. We've narrowed the difference this year versus last year as the year has went on. Okay, we're now at the point of the last 2 or 3 weeks. The yearling market is a little bit behind what it was last year. I think that has a lot to do with feedlot returns. When we get to here in a few slides, feedlots are projecting red ink and they're pushing back on what they're paying for incoming animals. This is the weight class where you see that. All right, so we'll jump over those. Fed cattle market. This one's set up the same way. Again, most of the year we were ahead of last year. We've been on par the last 3 or 4 weeks. This is where the net of we put more beef in the system than I thought earlier in Q2, Q3, right? That kind of pressure is built. And there's been softening on beef demand in the last few months, and fed cattle will first see that. So that's my narrative for that on why we've narrowed. We went from being ahead back here in the middle of July to being on par here more recently. This is probably my least fun slide to share. It's particularly not fun here, Garden City and so forth, where there's a lot of feed yards. Every month I put out something called a feedlot return, net return effort. I take information from the Animal Science and Industries Focus on Feedlot Survey, and I marry it up with market information to approximate what I think returns in the feed yard are if you're not doing any hedging. So what I'm presuming when I do this is you pay the cash rate for an incoming roughly 7-8. You take the cash price when they exit the yard, and you pay the going cash rate for grain, Garden City grain in particular. That's what I'm modeling here. So the good months are extra high, the bad months are extra low because there's no risk management involved, right? So in truth, when yards mitigate some of these risks, they'll never experience the high highs and the low lows that have in this exercise. That is important to keep in mind. But I think it's still a good barometer of the like cash to cash market forces that are at play. And that's what I'm mimicking. For January, I put a red here because it's the worst month. Okay. I'm doing this to give you context about why I think we've hit pause in the yearly market. January, I've projected a loss of $126 per steer. So every steer that would be leaving for this exercise in January would lose 326. And the main reason for that is that was really close to the peak point on what we paid for those animals coming in. So roughly 7 months before that, this exercise, somebody paid $263 for a 750 pounder. Okay. Please notice the fed market is relatively flat. This 180 range is what's being forecasted. And we've had a small gain actually in the cost of gain, which isn't good for Dan's talk, right? But the biggest difference here on animals leaving January was they were really expensive when they came in relative to what we could get for them going out. Okay. And these are all negative. That's the worst month. That's where I would put red around it just to interpret that for you. But I think this is what's pausing the yearly market is feedlots are looking at abnormally negative margins ahead of them. And that's a challenge. Now, please notice my risk management comment. I don't think many Kansas yards recognize, will realize this much whipsaw because they have different risk management in place. But that doesn't change the general trend of negative margins. It mitigates the magnitudes, but they're still facing negative margins. Yes, Dave.
On their corn inputs and other feed inputs, are they in this model? Are they hedging ahead or just a hand cash to mouth?
Everything's cash. So even more narrowly, if they're in the yard for 6 months, they're paying the going rate for each of the 6 months. Okay. And real narrowly, that January forecast, I'm projecting what the grain price is going to be between now and then using the forward tied to Garden City. Yeah. So if they've protected against a rising grain price in the past, they benefited. The flip also applies today. Had they protected and they didn't need to, they haven't experienced the lower grain prices, right? So the hedging goes both ways depending on it. So this is cash on all 3 legs of the margin story. All right, let's talk a minute about beef demand. We're running out of time here. Um,
16 minutes.
Yeah, we're doing great. Yesterday I went long because the questions at the end. I'm gonna try not to do it today. But the questions are great, so please keep them coming to me. I'll skip slides. I want to talk about demand for a moment. I'm gonna skip my blue jean example here. Rather, I'm gonna encourage you to go read this. A decade ago, I wrote this thing for Beef Magazine. I try to illustrate the difference between consumption and demand in a fun way about blue jeans. Please go to that. I'm gonna jump to my next slide here and spend more time on some scatter plots. But the punchline of this is demand is not per capita consumption. So per capita consumption is projected to go down by 4 pounds in the next 2 years. That's what the text box up here is. In 2026, maybe the typical person in the US will consume 54.5 pounds of beef, and that would be quite a bit less than we have at the moment. This slide, I'm gonna let you stare at for a moment. I got 3 in a row that look like this. I'm gonna tell you the history lesson and why it's really important. So per capita consumption is just tonnage on the market. The beef we produce, plus what we import, minus whatever we export, make an adjustment for cold storage. We can kind of ignore that, but we do it. That's the net of that calculation is all beef pounds. So the beef pounds on the US market, and then we divide that by the US resident population to put it on a per person basis, per capita. That's how you come up with pounds per capita, which is the horizontal axis on this chart, okay? For historical context, 2007 back to the late 90s, 65, 68 pounds of beef consumed per person was what we had. The Great Recession, 2008, 2010 is here. It's in red with an ugly flat red arrow because that was really bad in the industry and bad beef demand. There's a real simple way to illustrate this. The industry went from the 65 to 69 pounds per person to an era of 60 to 62 without experiencing a higher beef price. So this chart has beef price on the vertical, okay? Typically, when you take volume off the market, if demand is anywhere near normal, there's a price quantity trade-off. So when quantity reduces, we expect the price to go up, right? In this period, that was not accomplished. Q declined, P did not go up. So P times Q is less dollars, right, from consumers coming to industry. The size of the pie for the industry shrunk. The only way that happened was I know demand fell. Price did not go up when we took pounds off the market. That only happens when demand declines. So this was the Great Recession, the macroeconomic events back then you guys are aware of. That wasn't fun to talk about. Fast forward more recently, now we have a green arrow. It's more fun to talk about. 2018 to 2019. Notice how the 19 is to the right and up. So in 2019, more beef was consumed per person and the market clearing price was higher than it was in 2018. I don't need any assumptions on price sensitivity or elasticities or geeky models to tell you that if the quantity went up and the price went up, the only way that happens is beef demand was stronger in 2019 than 2018. Anytime you get any industry to consume more of something at a higher price, that only happens if demand grew, okay? Now, it's my job to geek out and tell you how much it grew, but just by directionally think about that, okay? 2019 to 2020, 2020 to 2021, directionally was the same thing. So for 3 years in a row, the industry succeeded in getting more beef consumed per person, which is what was happening with the cattle cycle. Remember this, right? More domestic on the market, but did not sacrifice on price because demand was growing. That's great. And when I made the comment about beef demand been pretty good over a period, this is what I'm alluding to is multiple years there that was going on. Now go forward. Now I've given you both a green and a red arrow because I'm not Nostradamus. I don't know where we're going to go, but we can talk through 2 different pathways. So I told you where we're at the cattle cycle that I think we're going to have less beef on the market. Right? I'm reminding you of that up here. Maybe this 4 pounds less out in 2026. On the horizontal part of this, that 55 pounds is going to be like here, and maybe the year after that even lower. So we're going to be somewhere out here in this realm of the 14, 15, maybe even a little bit left of that when we're thinking left or right on this chart. What the market doesn't have any clue on at the moment is how high, right? Vertically, right? What will be the retail price that clears it? This industry should be cheering for the green arrow to occur, for us to have a historic high on the retail beef price, and for the, say, the 2026, 2027 type dot to be something like where my dot is now. Why am I saying that? Because that would be the outcome of less pounds, but a higher price. If we move to the left because it's less pounds and we fail to increase the price, it's a repeat of what I told you back here in 2008, 2010. Which is why I give you this history lesson, okay? I've just interjected to you the concept of demand with the price and quantity trade-offs. We gotta understand both, to understand the strength of demand. Per capita consumption is just one dimension of that. Right? The industry is not better off simply because we increase consumption. If you increase the consumption, but you give the farm away on the price, your P times Q doesn't grow. So you gotta understand both P and Q, right? Think of it that way. And if the total P times Q isn't growing, there's less dollars for the industry to subsequently support fed cattle and feeder cattle prices and so forth. All right. The other part of this, and I'm not trying to be political today, but this is the first one of these I know is, there's a lot of discussion in the media about food prices and accusations of gouging and so forth. The beef industry internally should be cheering for the outcome I just described to you. A higher retail pricing we have today. And if it doesn't accomplish that over the next 2-4 years, we have a demand problem. Because we're in the process of taking pounds off the market. That's at total odds of the general media discussion around food price. Okay. To that point, I'm going to kind of wrap this up. Consumer confidence, there's mixed signals on this. Earlier last week, Yahoo Finance had this piece, consumer confidence in a recent low. That's my segue to remind you about one of the projects I lead here at K-State, the Meat Demand Monitor, MDM's the acronym. It's beef and pork check all funded. I'm going to highlight just one piece of this. I'm happy to take questions on it. I usually give full talks on this particular effort, but I want to call out the sentiment part of this. I'm going to jump to this slide for the sake of time. So every month since February of 2020, we've asked people in this MDM effort, national big survey, compare your finances, household finances today to a year ago. Are they better? Are they worse? Are they the same? You got to tell me one of those three. In July, the figure you're looking at right here, 20% said their finances were better than they were in July of 2023. The remaining 80% are split between they're the same and over a third told us they're worse. The reason I include this chart, it's all I want to bring to you out of this effort, is the biggest change people make when they say their finances are declining is they reduce the amount they spend on food away from home. And break that down even more, I've got questions in here about like where did you have your meals and so forth, and I will tell you just foot traffic difference. They don't go to a restaurant. So yes, they probably changed what they pick off the menu a little bit when they're in the restaurant, but the biggest change is they just don't go to a restaurant. They eat at home more. So there's a tightening of your belt on at-home food expenditure that's real. We should not ignore that. But the biggest change is foot traffic through restaurants. And that's the biggest softening of beef demand the last 3 to 6 months, particularly steak demand, that this industry depends on restaurants more for than ground beef. We sell a lot of ground beef through restaurants too, so I'm not going to only ignore it. But when you break down the carcass, steak demand in particular depends on restaurants, and that's a challenge. Happy to answer more questions on that. I'm just going to try to make my final point here. Last night we had the VP debate. I'm not here to tell you who to vote for. I won't do that. I don't think that's appropriate. But you can't look at the media and not have things like this show up. So I read The Economist regularly. I get time and I'll keep up with it. But these are just examples, right? There's lots of examples where there's a lot of interest and emotion discussion, right, on where we're at politically. I think we could all agree emotion is pretty high. I'm just reminding you of this. With that in mind, I'm going to read these two to you. I'm going to try to tell you why I think this is relevant in my remarks. From Proverbs, it is to a man's honor to avoid strife, but every fool is quick to quarrel. And from James, my dear brothers and sisters, take note of this. Everyone should be quick to listen, slow to speak. I've used this visual image in several talks. It's my job to give the talks, so this is a little bit odd because I'm using my mouth a lot at the moment. But I think we have 2 ears and 1 mouth for a reason. And I do a lot of youth coaching, and sometimes I've reminded young boys of that. You need to quit talking to listen to coach, right? This kind of stuff. I actually think on the personal citizen front, we could all do better of listening and conversing and barking less. It's the first reason I interject that. So just personal plea, proud father of 3, I think it's a good reminder. But honestly, I think this is relevant for running ag businesses as well. And this is why I'm comfortable doing it with you today, because I think there's personal value to it. So that gives me the first reason. But the second reason is everybody in US ag has a customer base that probably doesn't look and have the same background as us. And because of that, we need to listen to the customer, and sometimes that's a challenge. Okay. So I trust we all know where Kansas is, so I won't give a geographic lesson to this group. But as a reminder, there's about 3 million residents in Kansas, and there's 18.1 million arable hectares. And I was lazy, I didn't convert it to acres, but just keep that in mind. The part that's relevant is how does that compare to the rest of the country and the rest of the world? Kansas is home to less than 1% of the US residents and less than it's 0.04% of the globe's beef. Okay, conversely, we have over 11% of the arable land in the US and 1.33% of the world's land. So from a land production perspective, we feed the world, right? Relative to the number of people is the reason they give you those percentages. We have a lot more land than people on the global and the national stage. The top right is the Kansas cattle numbers. The same thing, Kansas is a big part of cattle and subsequently beef production. You guys know that. The reason I'm interjecting this here as an add-on to the two Bible verses I gave you is by definition, Kansas ag, and I'll say US ag just in general, I'm using Kansas by example, produces and sells, it's a net exporter, right? I'm the beef cattle guy here, right? But we raise a lot more beef than will ever get consumed in Kansas. And with that, there's a lot of people that are buying that beef that have a different background, different questions. Quite frankly, man, I know what a cow is. There's lots of examples of that we need to recognize and get better about that. So my comment about pausing and listening and conversing, I think it's very appropriate in the current emotional political cycle to do it. But it's also, I think, a prudent reminder to those of us in commercial ag. That's part of doing business when you have an industry that's much bigger than your county or your state. And if we only want to listen to and talk to people that are from our same background, we don't need 31 million beef cows anymore, right? To be really blunt. Don't do this to tick people off, but I think there's a business reason to think about that. And I think there's a personal, proud resident part at the moment. I will stop with that. Happy to take any other questions for whatever time we got.
Just repeat them if they come in.
Yep.
Around the microphone.
And if there's any online, Rich will tell me as well.
Yep. Go ahead. We got a few minutes.
Yes, Dan.
Will the dock strike, potential strike impact meat exports, container movement, things like that? Do you have any concerns?
Yes, I have concerns. I'm more comfortable when the world is operating as planned, right? So when there's a lot of foreign buyers of US meat that will pay more for those products than we will at home. So that's why I like when the ports are open and that part of the demand signals can occur. My current response would be the duration of any kind of strike is what's really important. So if it's a couple days, it's going to be a lot more of an issue in the news and so forth. I think we can kind of manage through that as call it a hiccup that wasn't fun. But if it goes very long and customers don't get the product that they've been promised, they're not going to keep repeating orders, right? So I get worried about export demand for meat if it persists. Now you can break it down by which ports. So the current dilemma is more east and southeast, not the west. And we don't send all products the same through all the ports, right? So a fair amount of the meat that goes to Asia goes out through the West Coast. And as of today, fingers crossed, those aren't the ones we're talking about, right? Poultry products, for example, I wouldn't say that about because where we have poultry in this country, it's a bigger deal for poultry exports than it is beef, if you follow me at the moment. And I think it's a bigger deal for grain on balance than it is meat at the moment. But I don't like any of these disruptions that mitigate global trade's ability to get the right product in front of the right people. The extreme example would be is we export over 90% of the livers. And if we get those to Asian markets that value them more, they're going to bring a lot less on the US market. They have to stay here, right? And eventually that would start depressing fake cattle prices and so forth if there was a long tail to it. So